Joining us now, Priya Misra, fixed income portfolio manager for JPMorgan Asset Management. Thank you for being here, Priya. So much to get into on the fixed income front. You think that those three strong CPI prints are a bump in the road, similar to what the Fed has indicated as well. Why is that?
So I think a few things. The inflation data itself has been mixed. So if you look at the PPI report or the PCE report, some of the components that took CPI higher, auto insurance, medical care services, that's actually much weaker in some of these other reports. Plus, I'd look at, the inflation strength has all been in services. I think that's linked to wages. If you look at wage growth, despite these 250,000 payroll numbers, wages are actually moderating. So our view is as wages continue to moderate, that's going to bring downward pressure on service inflation. And also, we've had significant progress on inflation. Remember, CPI was 9%. Okay, it's running 3.5%. It's still not at the Fed's 2%. But the Fed's telling us maybe they can start. They know it's going to be a bumpy process globally. We heard that from the ECB as well. So our view is, yes, it's three strong data prints. I think it tells the Fed there's no urgency to cut rates. But I do think they want to cut rates later this year. We're thinking July, September, in that time frame, to start the process of normalization. Interest rates, 5.5% on Fed funds is not normal. Perhaps we can argue maybe it's going to be 3.5, but not 5.5. So start that process. I think that's why I think they're going to view this as a bump in the road. They're going to still say no further hikes. I think that's what the market's really focused on.
So you've got the 10-year at 4.571 right now. Where do you see that peaking in light of this dynamic?
Great question. I think one that is going to have an impact across asset classes. We hit 5% late last year. I think if we're going back to 5%, that's a problem for every asset class. But remember, when we hit 5%, there was concern around the deficit. There was concern around the Fed hiking a lot more. If you think the Fed's not going to hike and we're actually going to talk about rate cuts, I would argue we're close to that peak. 4.5, 4.7, somewhere in that on the 10-year Treasury rate is where I think we're going to peak. Now, we can debate how much our rate's going to fall. If we stay in a soft landing, I think we stay 4 to 4.5. If there's a recession coming our way, then that 10-year can rally a lot more. So, right now we're in a soft landing. The data looks very solid. So I think rates have peaked. We can just debate how much they're going to, come down.
You mentioned that services inflation is largely tied to wage growth. Now, if you go back a year, you had Fed Chair Powell who would be pointing to that relationship as a way of saying we probably have to slow down demand in services in order to get inflation where we want. And one of the reasons it seems that markets in general have been more comfortable with the whole setup starting late last year was inflation was down enough. The Fed said we don't really have to run the economy, below potential for a long period of time. Is there any threat that equation changes, that the Fed that starts to question whether we can have it all?
I think if the labor supply, I think the surprise for us has been how much the supply side of the economy has worked. It's allowed the soft landing to continue. And I think the Fed is viewing that very positively. So not just supply chains on the goods front, but the fact that labor supply has been so strong, it's allowing these 250,000 payroll growth per month to allow to still be consistent with a 0.3, 0.4 average hourly earnings. So what can threaten that is if labor supply stops. For some reason, immigration or there's some political issue and we have an election coming up, if you get a reduction in labor supply and companies continue this hiring pace, I actually think the hiring pace is likely to slow down as well. But if it doesn't slow down and we start to see wages re-accelerate, then this nightmare scenario for the Fed, and I would argue for broader markets, re-acceleration, which brings hikes back on the table, I would still watch the totality of the data, watch wages. Inflation expectations would be another one. If the consumer starts to think, when inflation expectations are heading higher, they're going to demand more wages. So I still do come back to the labor market, to wages. And if the supply side continues to operate, I think that soft landing, I don't want to take it for granted, but we can keep that as our base case.